Good afternoon. The time is 12 p.m. Australian Eastern Standard Time, and the day's date is the 29th of January. And you're listening to Angus Geddes. First of all, I want to apologise for the audio not being posted on Friday. We did have a few technical issues with the file that was uploaded, and unfortunately the file was corrupted. So my apologies to anyone who was inconvenienced by that. Well, turning to the markets, we've had it's been an interesting morning, really, with the front page of the Financial Press heralding in the start of a new bull market in Australian stocks. We've also had a lot of discussion in the media about the new bull market in US stocks, well, the ongoing bull market in the US stocks, and there was some comments from Ray Dalio at Bridgewater, which is the largest hedge fund in the world, basically saying that there's a tsunami of cash and liquidity that is going to pour into stock markets and other asset classes around the world this year, and that we're going to see a huge rally in most asset classes with the risk off, risk on dynamic now at a much more relaxed levels. We have the VIX below 15, the volatility index permanently or perhaps sustainably below that sort of 14-15 level, which is really, I guess, encouraging investors to seek out a better return on their cash and their term deposits, and we're seeing a lot of that cash move back into the stock markets. Now, of course, this is a trend that we've foreseen for some time now. We've been talking about this bull market in stocks and equities really beginning to gather momentum since last year. So whilst we've got a lot of bullish rhetoric around it at the moment, I'm still comfortable with our medium to longer term view. I'm beginning to think that stocks are beginning to look overbought in the very near term, and in fact, and indeed, a lot of the bullish commentary coming from the media makes me a little bit concerned that near-term markets may enter a correction. Now, I want to talk about the correction because I think we will have a correction at some point, if not later in the first quarter of this year, certainly in the second quarter of next year. And what I want to illustrate really is that, like last year, I think perhaps if markets do correct, it'll be a lot more subdued than probably what a lot of people think. In other words, we may see stock markets only go down sort of 5 to 7% before the bullish uptrend continues. So I think, therefore, investors, we need to think carefully about the ramifications, I guess, of trying to time the market and cash out at a what could prove to be a near-term peak. In other words, I'm questioning this year really whether to sell too many of my holdings down, because I guess I'm more sort of focused on capturing the medium and the longer term trend in equities. And I think we did a lot of the hard work last year in terms of steering the negative sentiment and the pessimism and the fear in the face, and we've built out our equity exposure, carrying very, very low cash levels, our maximum equity exposure, and I'm sort of a little bit reluctant to tamper with those portfolio settings. Last year I made the mistake of not selling down our resource exposure aggressively enough and really got caught in that whole corrective sell-off, which was of course a lot worse in the resources part of the market, and I think we've come through that, so I don't really want to be too premature and basically selling out. So look, I'm going to continue to watch these markets, but I'm quite comfortable at this moment in time carrying a maximum equity exposure. And having said that, it is becoming increasingly difficult to get set in stocks. You know, we're finding that we're chasing equities to the upside in terms of on the buy side. It is becoming difficult, and you know that is a sign that The sell side, which so dominated the stock market for the last few years, is really exhausted. So I think that's where we are at the moment. Last week I published in one of my dailies a note about the US stock markets moving up to their record highs, around 14,000 for the Dow, around 1,500 plus for the S&P 500. And I've got to highlight that there is risk to our forecast that the US indices will correct and not push through those resistance levels. I highlighted that I could in fact be wrong, and that maybe Ray Dalio at Bridgewater is going to be right when he sees a wall of liquidity storming the market, and perhaps I will be wrong and those resistance levels may get taken out. I think if they were to get taken out, the bullish impact on sentiment around the world would be quite powerful indeed. And I've been saying for some time now that the stock markets that have underperformed the US indices in the past 5 years, that is the Shanghai Composite, the Nikkei, and the FTSE, and of course the ASX 200, we may see some of that underperformance made up, and we could see those markets actually have a very, very strong year this year indeed. When I look at the All Ords, the ASX 200, our forecast of 5,200, and we're at 4850 already, and we're not even through January. We're only 350 points away. It's beginning to look tame, or at least conservative. So, interesting times, and I think that the overall direction for the stock markets is going to continue to be up. So reluctant to take any money off the table just yet. Turning to the commodity markets and gold. Gold corrected on Friday in the face of the stronger manufacturing and durable orders data that came out of the US. And we're getting continued evidence almost on a day-to-day basis that the US economy is now growing. Of course, we've also got the prospects of China's growth rate accelerating. The European situation is now stabilising. And now we're going to have Japan trying to jumpstart their economy through bringing down the value of the yen through quantitative easing measures. And if anything, this probably says that the risk to the market is actually to the upside. Now, I think near term we've seen the gold price correct, and with gold coming back to 1650, it says to me that maybe some further consolidation is going to be needed. We're going to see some further ranging and sideways trading activity until the gold price is ready to push up and test it at 1800 high. I've highlighted today about George Soros. This is in my daily, making those comments in at the Davos conference about the risks to the inflation rate, and in other words, he sees the advent of all the central banks with the quantitative easing programs actually increasing the risks of inflation. And I think this is why he's been steadily accumulating gold for his own private portfolio over the last 12 months. So whilst the price action in gold has been negative, I still remain true to our forecasts that the gold price is going to go a lot higher this year. And if anything, we're going to continue to see the purchasing power of currencies eroded as central banks continue to devalue their currencies. But it may be a few more months yet before gold's finished its consolidation and before we see a test to the upside. In the meantime, I think gold stocks trading and being valued at very, 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 very cheap and opportunistic levels at current prices. So on that note, I wish all of you a good week, and I look forward to joining you same time this Friday. Once again, I apologise for the corrupt file that we had, the technical problems that we had on Friday. Bye for now.